Let's talk about conducting these procedures. Well, these are usually going to compare current year balances to prior year ones, or external balances such as those of a competitor or the industry average. Right, you're going to have a good old balance sheet and income statement. But let's think just a trial balance. You've just got all these items. You've got your 1231 amounts, and as of 1231, you've got cash is a certain amount, debt's a certain amount, equity is a certain amount, etc. Revenue, expenses, all of your accounts, and you're going to compare them to, let's say, this is last year. You could also have the industry average, like we said, or a competitor, and you're going to just in Excel do a nice little formula, compare these two, take the variances, do a percent change formula, do all those different methods in order, like I said, get a percent. What's the difference? Now, if let's say we could say normally, okay, revenue is expected to increase by 5%. Maybe that's what it is in this case. It may be different amount, but generally speaking, amounts shouldn't change radically. And if they do, obviously you've got some sort of concern. But when you get to analytical procedures, you form these expectations before you even do the procedures. So if the change was, or the variance was more than a certain percent, it stands out and you can assess what happened. Now, these analytical procedures usually use financial and non-financial data aggregated at a high level, and these procedures are required to be used during the planning and final review phase. Keeping that in mind, what's the additional phase we could do them in? Well, that would be the testing phase, and you're not required to use analytical procedures during the testing phase in the middle of the audit. However, you can use them as substantive procedures. That's very much covered in our substantive procedures lesson, so not going to cover that too much here. We're going to cover analytical procedures as it comes to planning and final review. However, you know what? I'll probably end up talking about that at a certain point anyway, because I want to make sure anything that is going to be on the exam, I really beat to death, and you are going to get points for it. Now, the first step for performing analytical procedures would be to develop an expectation of a balance or ratio by using relationships that are expected to exist. How could you do this? You could look at multiple years. Let's say this is your 5th year auditing the company. What was the percentage change between the cash balance every year, or the percentage change of the income statement amounts? Now, generally speaking, income statement amounts are going to be better to test here because balance sheet amounts are a point in time and they have less consistency in them, right? Revenues, you'd think, okay, revenue, you want to consistently increase. Expenses, maybe you want to keep constant or maybe decrease. However, the amount of cash you have or debt, that could change depending on the strategy you employ that year, or just many other factors. What are some examples here? Well, we could convert dollar amounts of income statement account balances to percentages of net sales for comparison with industry averages. You can turn dollar amounts into percentages. You can't compare dollar amounts to other dollar amounts from other companies, because you could have a company that has $1 billion market cap and a company that has $100 million market cap. So say a company's 10 times the size of another one, dollar amounts are going to be significantly different. And to say that one company increased their profits by $10 million, that doesn't mean anything to me, because if they made $10 million by investing $100 million, right? Like basically I'm just throwing dollar amounts out there, but you can summarize it all up by, we had a return on capital of 5%, which, okay, cool. Well, let's compare that to something else. Let's say another company had a return on capital of 50%. So the return was 50%. That's all much better than 5%, right? And again, companies of different sizes, you can't compare those dollar amounts because it doesn't show the efficiency at which they made money, made their profit margin, reduced expenses, anything like that. We could also develop the current year's expected net sales based on the sales trend of similar entities within the same industry. So instead of just looking at prior year financials, we could also look at other entities that have their published financial statements out, and we can develop expectations based on those. We can estimate the current year's expected expenses based on the prior year's expenses and the current year's budget. Obviously, you can use the internal entity's assessment, which is their budget, in helping assess what you expect to happen. You can compare current year to prior year sales volumes. I mean, really, you can compare current year to prior year anything, not just sales volumes. You can multiply the average outstanding loan balance by the interest rate and compare the result to interest expense actually recorded. Now, this is one that you could say is likely a substantive procedure of recalculation. However, you can also use this as an analytical procedure of developing an expectation of what interest expense likely should be. Lastly, here you can compare inventory balances to recent sales activity. If sales activity increased by 10% and inventory balances, you didn't increase your inventory throughout the year like by 10%, well, what happened? There can be many reasons for discrepancies, but obviously having these expectations and then being able to look into them afterward is critically important. All right. As promised, I decided to dive a little bit into substantive analytical procedures. Why not? Let's dive into them and make sure you're familiar because this is something you could see on the exam. Now, when designing and performing analytical procedures, either alone or in combination with tests of details, as substantive procedures, the auditor should. Now, what should you do? Again, this is using analytical procedures, so using ratio analysis and expectations to do actual test sub details, to do actual testing. And what should you do when you are using analytical procedures to test? You should determine the suitability of particular substantive analytical procedures, given the assertions, essentially just assess, are we testing existence, valuation accuracy, something like that? Just assess, is it suitable for that test, for that assertion? Next, evaluate the reliability of the data. If the data is not reliable, then you probably shouldn't do that. I'm kind of breezing over this because, like I said, this is covered in our substantive procedures lesson. I just wanted to include it in here, give it the perspective, again, within its own lesson. We could also develop an expectation of recorded amounts or ratios and evaluate whether the expectation is sufficiently precise. There's just additional testing. You can see this in relation to possible material misstatements. And lastly here, you can determine the amount of any difference of recorded amounts from expected values that's acceptable. Because you could have expected variances between ratios, and if those are off, obviously you should investigate further. You can use this in our tests of details. Now we're going to talk about analytical procedures when you are forming an overall conclusion. As mentioned, you can perform analytical procedures in the planning phase, which is required. You can do them in the testing phase in the middle, which is not required, however, it's helpful. And then lastly, in the forming conclusions when you're creating an opinion, which is required as well. The auditor should design and perform these procedures near the end of the audit. Kind of think of this like a catch-all, like a net where you're trying to form an overall conclusion, catch anything you may have missed, look for any red flags at the very end. Analytical procedures performed near the end of the audit are intended to corroborate audit evidence obtained during the audit to assist the auditor in drawing reasonable conclusions. So you want to assess and say, okay, take a look back. So we formed our initial expectations in the beginning of the audit with our planning. Then we tested. And then we want to use analytical procedures to see if the concerns we had in the planning phase were alleviated by the tests that we performed in the testing phase or right through the other substantive procedures. In the conclusions, you want to make sure that there's nothing left that could possibly mess up your reasonable assurance for the lack of material misstatements. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.